You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, let's start this week by looking at last week's trade. Last week's trade, it was a paper trade, a long calendar spread in Apple, and it hasn't done very well. Apple hasn't been very considerate of the trade that we put on. And a lot of times those are better learning experiences. So I want to talk about the Apple trade because it was all about the setup. The trade that we discussed is a long calendar spread in Apple before earnings. Now, we are getting into a very interesting time as far as earnings season is concerned. On the 29th, we have a boatload of FANG stocks announcing earnings. On that day, we have Google, we have Apple, we have Facebook, to name a few, that will all be announcing on the same day. This week, we have Microsoft, which is going to announce on the 27th. Not really a FANG stock as far as the acronym is concerned, but it is definitely considered part of that group. And so we wanted to take advantage of the fact that the markets have been volatile just in general and sell some short-term premium to help pay for a call option contract that we might like to be long going into the Apple's earnings announcement. So last week when we were looking to put on the trade, it was October 14th. Apple was trading at 121.19, and we went out and looked at the 127 strike. Now, a calendar spread or a time spread, if you will, means that we're selling a short-term month and buying a long-term month. In this day and age, we're talking about weeklies instead of months. So we actually sold the 23rd expiration, which had 9 days remaining to expiration, and bought the 30th expiration, which at that time had 16 days remaining to expiration. All right, well, it's now Wednesday, and I should mention we're taping Options Playbook Radio on October 21st. The market is open right now and running. And since that trade was put on, the ideal scenario for us in Apple would be that the underlying stock would drift up towards that 127 strike price. Well, Apple hasn't even came close to that. As a matter of fact, since we talked about it, it was the close on Wednesday that we talked about it. On Thursday, the market has drifted slowly lower, and as of right now, it's trading at 117.14, so it's down approximately $4 from when we talked about it on the show. Okay. So, highlighted on the show, some things that we talked about is that, we wanted to buy the October 30th expiration, even though implied volatilities were fairly high because of the known news event. The implied volatility was trading around 48% on that option contract that we bought. And then we sold an option contract in the near term that was trading at 42%. Now, that was fairly important to us because that meant we actually got something for that option contract. So we were able to do this entire long calendar spread for $1.45 to the account. The option that we actually bought was trading right around 260 at the midpoint. So we're greatly reducing our cost as opposed to just buying that option outright. Now, the underlying has gone down, and what I wanted to highlight here, because we set up the trade the way that we did and we didn't have to battle implied volatility, we're still doing okay on that trade. Even though the stock is down $4 from when we first talked about that underlying, if I pull up the quotes right now in the Ally Invest option chains, I see that October 30th expiration with the stock at 117, trading at about the midpoint, right around 88 cents. That means we put on this trade for 145, and we could get out of it by selling that option contract outright. We'd have to buy to close the short-term option, but that's trading for next to nothing, a few pennies. And we would be down about 57 cents. Say we spend even a nickel to close the short-term option contract. I don't think you would have to, but let's say a nickel. You're only down then about 60 cents on this entire trade. Okay, why is that? Well, that implied volatility number that we talked about being at 48%, we anticipated to go higher going into earnings. And guess what? It's now trading at 52% implied volatility. So because of that, we can still get out of this trade at a decent price to the account and basically not even lose half of our investment on it. Now, with the stock down 4 points, means our strike is now about 10 points out of the money. We could obviously just let it ride, expecting that short-term option to expire worthless, and we're still into our long call option at a decent price, and we made a profit on that short-term option contract. So with that said, that is one way that you could approach it, is to just go along with it. You do got a little bit harder trek now to get up to the actual strike price at where we would be profitable. So there is another alternative on this trade. That's not a bad alternative right there. Personally, because we set up the trade right and implied volatilities are going higher, and now you're talking about a 10-point move in that underlying, which is about the expected move, actually, I would probably just close the trade and move on. Didn't hurt that bad because we set it up right, but that would be where I would go with my trading and what I would do. Now, not meant to be a recommendation. Everything on Options Playbook Radio is consider paper trades, and you should be paper trading them until you learn these type of strategies. But the next alternative that I think many people would opt for is the fact that because implied volatilities are high just in general, you can go on out and buy to close that option contract that is almost worthless, trading for pennies, and then sell to open a strike that's higher than our current long call strike, effectively rolling into a long call spread. And I just looked at that quote, and if we sold the 129 strike with the 30th expiration, we're not out of the game then. and we still capture a lot of our initial money that we put up in that. I told you we could sell our current long option contract for about 88 cents. That's approximate. The markets are moving as we speak. And as opposed to doing that, let's say we sell the same expiration, the October 30th expiration, but we sell the 129 strike. And if we do that, we can bring in about 64 cents. So we're still in the game. We would effectively roll into a 2-point wide spread. Our probabilities of getting to the 129 strike are a lot lower now, considering the stock went down 4 points when we initially put on the trade. But it's an interesting alternative. And the main reason why we can still do this is that implied volatilities are still increasing as we approach earnings on that big event day, which is the 29th of October. Okay, so like I said, to me, it is more interesting if we actually go into these trades and they are not winners, because then you can look at, well, what's our mindset at this point in time that we're talking about them, and what are some of our alternatives? And that's the biggest thing about option trading, is that even though sometimes when the Lord gives you lemons, you have to think about, how am I going to make lemonade with them? And in the options world, that really applies. And here is a great scenario where it went down, but it didn't blow us out of the water to the downside. So we do have some alternatives to do that trade. Now, with all that said, though, I very rarely will look to do two different hedges. If I put this trade on and I do the roll and I roll into the long call spread, that's going to be it. I'm just going to put that trade on. I'm going to wait till earnings. I'll wake up at about 10 o'clock, a half hour after the market's open, and I'll see, okay, where is Apple at that point in time? And if it goes on down, oh well. If it continues down, no big deal. And if it's in the middle, well, then I got a decision. But my idea here is I've already hedged it once. I could make another $2 if that stock can make more than the expected move to the upside, and then I'd just be happy with that trade. Just that simple. Okay, so let's keep this theme. I've been talking about volatility. The FANG stock that's really going to start kicking it off. Well, Netflix actually already announced earnings the other day, but let's look at Microsoft. And I'm going to look for more volatility going into the earnings on Microsoft. So I looked at, when I first thought of Microsoft, I was thinking I was going to do an out of the money, either skip strike butterfly on the upside or on the downside. Something where I could try to target an area the stock might land in. But when I started to look at the chains in Microsoft, I'm like, I think I want to try looking for more volatility as opposed to less volatility. So that means we're actually going to do a ratio spread, a back ratio, where we're going to sell an in-the-money option contract to try to pay for two out-of-the-money option contracts. And that means that we're looking for this underlying to move at least the expected move. All right? So the expected move, it gives you a line in the sand. It's basically the over-under that you're expecting by that earnings report. Now, that earnings report is on the 27th, and as I mentioned, today we're taping Options Playbook Radio on the 21st. So you might want to hold these concepts and maybe look at the market on Monday or Tuesday, the day of the event. It's going to be after the close. So those are your considerations. But we tape Options Playbook Radio on a Wednesday, sometimes on a Thursday, but mostly on a Wednesday. And so because of that and that scenario, we're just going to use today's prices. It's that simple. Okay, so let's talk about the setup. First of all, we want to know what the quote-unquote expected move is that I was talking about in Microsoft. So the expiration that we're going to be using is the 30th, And the expected move is about $12 in that underlying, approximately. And like I say, it's not an exact science. So we'll just go with that. Now, it's going to be a little bit inflated. Why? Well, most of the time when you're thinking about the event after earnings, you look at option contracts that they had a couple of days to expiration. But we're doing this once again. We have 9 days remaining until that expiration date. So the expected move is going to be a little bit higher because it's got 9 days to move. So because of that, in general, it's just going to be a little bit higher, but we'll take it. Okay, 12 points is what we're going to round up to. It's a little bit less than 12 points, looking at the ask price of the call and the put at the 215 strike. All right, so ready to take notes? Let's get into the trade. Stock trading at 215.74. It's up around $1-ish today. We're going to look to sell the 210 strike call and buy the 220 strike call. And when we buy that 220, we're going to actually buy two of them. So it's a 1-by-2 ratio. We're selling the more expensive option contract. We're buying the less expensive contract, but we got to buy two of them. At the midpoint, we could get that done for a net credit to the account of $1.40. So that's $140 that we would bring in for every 1-by-2 back ratio spread that we put on, less commissions. You always want to remember commissions when you're doing your trading. So if we do this, we really hope that Microsoft will go above 220 after that earnings report. It is on a Tuesday, so you still have all day Wednesday, all day Thursday, all day Friday for it to trade and for it to move. Where we lose is if that underlying stock finishes after earnings right at 220. Our break-even point is the width of the spread, and we add that to our long strike. So if we're going to hold this all the way to expiration, we would have the goal of this underlying stock basically reaching 230. Got that? That means we want the stock to really move, and that's why they call these volatility spreads. Now, we are bringing in $1.40 credit, which is nothing to sneeze at. So our break even would be 330 minus that $1.40 received, or 228.60. Now, we're not going to hang on to this all the way to the expiration date. And part of the reason why this is an interesting trade is that the stock's a $215 stock. It's trading at about 40% implied volatility. I would expect it to go up a little bit going into earnings. And we do expect that to come back down, but we want to get out. If we're wrong on our forecast, we want to get out of the trade as quickly as possible. Now, here's the good news is that if we're really wrong on our forecast, we're still doing the happy dance, right? Because if the underlying goes down below 210, the strike that we sold, we did this trade for a net credit. That would mean that the 210 and the 220 would all expire worthless, and we'd be able to keep that $1.40 net credit. That would be our maximum. We can't make any more, but we would make $1.40 on our trade. We do have some additional risk, and the risk is the width between the spread. And I'd like to talk about that risk a little bit. Where does that really come from? Well, effectively, what a back ratio spread is, and you can always look at these more advanced option strategies 4 or 5 different ways, but you're effectively selling a short call spread to pay for a long option contract. So if you think of that, if you sell one 210 call and buy one 220 call, that's a short spread. But we're not buying one, we're buying two Okay, so now if you did the short spread, you can bring in a credit, and obviously that credit is greater than the cost of buying 2 calls, and that's why we can do this for a net credit of $1.40. But that also means that we have additional risk on this trade. So if the width of the spread, which is from the sold strike to the long strike that we bought, is 10 points. So we have $1,000 that we could lose at expiration. But where do we lose that? If the underlying stock stops right at 220, right at expiration, you could lose that 10 points or that $1,000 for every 1x2 spread that we do. But we have a net credit of $1.40 that would offset a little bit of that loss overall on that trade, making the max risk $8.60 overall. Now, if that happens, you should receive the stupid award. I like to give those out handedly. What does that mean? That means that underlying stock announced earnings. The market went to 220 and it just stopped there, and it stayed there and hung out all the way to the expiration date, and you rode this thing all the way to the expiration, because that's the only way that you can lose the maximum on this trade is at expiration, when all the time premium of this came out of the 220 strike call option, and basically all the options are expiring worthless at that point in time. Because if it goes above 220, you're long an extra call, so that's going to benefit you there. If it goes below 210, all the options expire worthless. You did it for a net credit. So it's an interesting trade to consider going into Microsoft's earnings event on the 27th. That's anticipated, right? Obviously, I always have to use the word anticipated because they could change that date. They have that right to do that, but that's the anticipated earnings date. Now, I bring this strategy up, mainly because it was my thought. I really was thinking about going further out of the money and trying to do a skip strike butterfly, one of my trades I talk about the most on Options Playbook Radio around earnings, and either do it on the call side or do it on the put side. But when I saw the expected move and I saw the option prices, I'm like, well, let's bet on more volatility than less volatility. Now, yes, this is a speculative trade, not meant to be a recommendation, especially if you haven't done ratio spreads before. You want to do this on paper, follow the pricing, see what happens with this position overall if you put this trade on. But it is definitely an interesting trade. And yes, you would put it in as a 1/2 ratio for that net credit that you would like to achieve. So every single 1/2 is considered 1 unit. So if you did a 2/4, ideally you're doing 2 units, if that makes sense. So you always look at the unit price when you're talking about ratio spreads. All right, so let's summarize here. Microsoft trading at $215.74. It's up about $1 today. We're going to go a little bit in the money and sell a call option. We're going to sell that 210 strike call option. We're going to go a little bit out of the money, and we're going to buy 2 of the 220 strike call options. These have the October 30th expiration. Microsoft's going to announce earnings on the 27th after the close, and we'll come back next week and we'll discuss this trade. And we'll also talk a little bit about Apple and see where that underlying is at. So big trading day on the 29th, and if you don't trade options the day after all of the FANG stock earnings, then you're really not a speculative option trader overall. So with that said, I do need to actually point out that we do have a digital conference going on the Ally Invest YouTube channel. It's called The Future of Investing, but the simplest thing to do is to go to youtube.com/ally, and you'll see the event there. You just click on it. You can register for it if you'd like, and you receive reminder emails. But the simple thing also is just to Google Ally Future of Investing Conference. And that's it for this episode of Options Playbook Radio. My name is Brian Overby. I'm known as the Options Guy here over at Ally Invest. You can email me at theoptionsguy@invest.ally.com. Follow me on Twitter. We do educational events all week long, not only here on Options Insider Radio, but if you follow my Twitter handle, I always put links to the event. That is at Brian Overby. And lastly, may all the options that you bought this week finish in the money, and all the ones that you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.